Amidst growing fears of a recession in the United States, investors in Nigeria are closely monitoring this development as capital flight from emerging markets is likely to impact negatively on the local currency. Experts say that the CBN may need to intervene in the FX market to stabilize the naira by way of adjusting interest rates or utilizing foreign reserves. But what are the implications of this recession fears on the Nigerian market? Well, not only Nigeria, even the African continent. Let's get talking. Industrial sector analyst with Chapel Hill, Denham, Mr. James Oladisa joins me to continue this conversation. It's good to see you. Thank you for joining the program.
Thank you very much for having me.
I think, James, we should start with the loss. Look at Jeff Bezos and Mark Zuckerberg, Elon Musk and all of them counting losses there. About $30 billion US overnight. I am worried. Tell us what this means and how it comes to you.
Okay, so I think we should look at it sequentially. There has been sort of a flurry of data that has been released from the US. On Thursday, we saw the ISM manufacturing PMI released. Then the following day, we saw the NFP, the non-farm payroll released. And what we saw was that employment data actually came in worse than expected. And that was an indication that, maybe there's a chink in the armor of the labor market in the U.S. and the hikes in the interest rates have started to, have caused the labor market to sort of tumble, right? Following that, we then saw news flows over the weekend around the fact that Berkshire Hathaway had, for the past few weeks had been divesting from, one of their largest investments in Apple. Right, and they had taken out about 50% of their portfolio, of their investment in Apple, right? And that sort of spooked the market because 50% is not small, it's a significant portion of their portfolio, and that drove or was the catalyst that drove the sell-offs that we sort of saw in the U.S. equities market last week, at the start of this week on Monday.
James, but the impact on stock markets and cryptocurrencies and also on crude oil prices, many are saying we might continue to see that evolve as we move on. What do you make of that too?
I mean, when you begin to see labor data show certain signs, it tends to indicate that, there might be fears of recession. And so investors then tend to look for safe haven assets. Right, and then you then see them, buying the U.S. Treasury instead of the equities market. You see sell-off. Crude oil prices are also affected. I think that in all of this, what's important to note is that after the sell-off on Monday, there was a rebound, right? And when people have actually taken time to analyze the data and see that. Maybe it's not as bad as we think it is because, following the ISM manufacturing PMI that was released, which is just one half of the data, the ISM manufacturing services sector, services PMI was released. And we also saw, an improvement in the employment data. So, it's possible that it's just an overreaction in the market, right? Spoke to the market and we saw sell-offs. And as a result, commodity prices, as well as the equities market, suffered for it.
But I would definitely ask you what it means for Nigeria. For us, we do a lot of business with the United States, of course, the United Kingdom and all of that. So when we have fears of recessions like this one, what does it mean for Africa's most populous nation?
I mean, so when you look at Nigeria, you look at our current structure of our FX market right now, we operate a willing buyer, willing seller market.
Yeah.
And effectively, that means that we're in some way exposed to global monetary policy. So with, recession, with the fears of recession, which, some say are not necessarily warranted. We saw a report by JP Morgan indicating that they had increased their odds of a recession over the next 12 months, increased from about 15% to 25%. I mean, if you look at that quantitatively, it's not a significant, the odds are not stacked, towards a recession. And so, what people are thinking that there'll be maybe an emergency meeting for, a surprise cut. I don't think that will play out. But by the September meeting, the Fed has through their body language, sort of suggested that we should expect, a rate cut. What that would mean is that treasury yields, which are safe haven assets for investors, will then become less attractive. And so you begin to, investors begin to look for where they can earn strong returns. And, even though there are other, markets that they can invest in, emerging markets typically come to mind because, the growth is fast-paced. And so, these investors tend to look at emerging markets, and we begin to see a reverse of what is happening now, where we're seeing capital flights. We begin to see capital flows back into the market, naturally because, the treasury yields are not as attractive, and, they are willing to take the risk in such emerging markets to gain extra return.
Well, let's stay a bit again. Go ahead, make your point, please.
Yeah, so in a nutshell, I think it's positive because, capital flows will definitely, one, to help with liquidity in our FX markets, and it would also help correct, some of the undervaluation that we're seeing in our markets in Nigeria.
Staying in Nigeria, do you think that at the level of investors' confidence is improving? We had that challenge before now, and at the moment, some reforms are being instituted, and government is standing firm on them. The likes of IMF and World Bank have said, well, that's the way to go, where some still have reservations around it. But do you think that the guys with the box, with the greenback, do you think they are pleased, or this will really attract them to coming to our markets at this very critical time?
So this is how I will put it. The policies that have been put in place are positive, right? What would impact the decision of an investor is, how long they are able to maintain, the direction of travel. So if you implement a policy, are you willing to stick to it, or do we eventually see that pressure translate to a rollback in such a policy? And I think that's what will be crucial for, the guys with the greenback. But we've seen that this administration has, put in some policies that have been positive, and we don't expect that, overnight we will see the result of these policies. But over the medium to long term, they will naturally, begin to reap the dividend of these policies that they've put in place. They've removed fuel subsidies, partly removed fuel subsidies, and that has improved, revenue for the business, for the government rather. The liberalization of the FX market, which has translated to a convergence in rates, is also a positive. We've also seen some more positive and more recent policies or decisions by, the authorities. The plan to sell crude oil in Naira is one of those. There's also the suspension of, tax or import tax on food items, just ease some of the inflationary pressures that we're seeing. I think all these things are positive. And if we're able to maintain our direction of travel, eventually investors will realize that this administration is ready for business, and we will begin to see these flows more consistently.
So at the moment, are we doing more of FPIs than FDIs? Obviously, it's always more of FPIs, right?
Yeah, it's more of FPIs. There are some legacy challenges on the part of FDIs that sort of keep them at bay. Insecurity is still somewhat of a challenge. We've seen an improvement in the security architecture of the country, but I think when we see that the security architecture over a long time has ensured security for the country, then we'll begin to see FDIs begin to play in our markets again. There's also the challenge of poor infrastructure, roads. Not all the railways are up and running, and so all these things sort of, they want these things to be in place. So when they come, it's more of a plug and play for them. And when we're able to put these things in place, set up this infrastructure, we will definitely see them, come back into the market. But it's not something that we would see in the short term, most likely in the mid to long term.
Even the price of crypto was affected. In all of this, we saw a drop, particularly with Ether and all of that. What do you also make of the implication of this on that market?
I think the assets, like if you look at cryptocurrency as an asset class, it's sort of a bet against or, on what will happen in terms of monetary policy. So, if if you see the Fed deciding to cut rates, then the investors in cryptocurrency believe that flows will move back to this asset class, and it would prop up valuations for some of these coins, right? And that would translate to appreciation in the value for the investor. And so it's sort of a betting, for how monetary policy is going to shape in the short to medium term. And that's how I think investors should be looking at it.
The last check, MPR now stands at, back in Nigeria, 26.75% from 26.25%. But my question really to you would be, some analysts like you say there might be a shift from equities market to the other market, because the interest looks very attractive. I really like to get your views on this, and has that impacted tradings in the stock market in any way?
So I think, the dynamics of both markets right now is quite interesting. I think it's really important that we understand, what's happening in both markets. So the fixed income market, as you rightly mentioned, 26.75 is our MPR. And it means that effectively the SDF rate is around, around 25.75%. And we've seen treasury bills or the yields in money markets sort of reprice as a result of that. And this just, it makes, consumers want to invest their money. You want to put your money in treasury bills, because what effectively means is that at around 25% or around 24%, you can gain an effective yield of around 28%. And if you're earning an effective yield of 28% risk-free, you ask yourself, if I go to the equities market right now, where am I going to get this type of yield? There are select stocks that can possibly deliver that, but we also know that the banking stocks are currently, sort of capped because of the recapitalization exercise. And so it means that we will most likely not see a re-rating in most of these names until they are done with the recapitalization exercise. And so that has sort of, hampered any re-rating that we'll see in the equities market. So, logically, if you think about it, I think the fixed income market right now is quite attractive. These yields are yields we've not seen before in the bond market, and in the treasury bills market, they are very, very high yields and quite attractive for new entrants. So I think that just taking a position in the fixed income market, avoiding the risk of the equities market, is something that investors are considering, and it's the reason why we might most likely see favor towards the fixed income market and not the equities market.
Well, let's wrap up with impact of course, we've talked about the protests in many, many, many angles, many ways, but let's look at it on economic development. And what is your outlook for, of course, local and the global economy, considering all of these challenges we've highlighted during our conversation?
And so the process that we've seen naturally, would have an impact on output. I think that's the summary of it, that because people are out protesting, which is their right, it doesn't mean that we wouldn't see an impact on productivity. There were some, over the course of about 2-3, the past few days or the last week, we saw some businesses put out notifications that, they're not going to be opening shop because of the planned protests and stuff like that. That has an impact on output, right? For what we've also seen is that estimates from experts indicate that, around 400 billion naira will be lost as a result of this protest on a daily basis within the country. And that's a lot of money. If you multiply that by the 10 days of the planned protest, that would have been about 4 trillion naira, right? Even if we're being very conservative and say 25% of that, it's still about 1 trillion, and it's significant in today's economy. Let's be real. And so I think that the protests, even though they are necessary, they are good, for those who want to express their opinion. They can have an impact on output. And so that's how we see it from our own view. And this doesn't just play in the Nigerian market. It also plays, in the global space. Naturally, once there are protests, because of the risks associated with it, we would see that output would definitely reduce.
Brilliant conversation as usual. Mr. James Ola-Adisa is an industrial sector analyst with Chapel Hill Denham. Thank you so much It's really good to see you.
Thank you very much for having me.